Good afternoon. This is Tom Alexander. It is Sunday, January 1st. Happy New Year. This is the first day of 2023. And my guess is we're going to start off the new year next week with a bang. And we have a lot to discuss today. First, a few housekeeping things. If you would subscribe to the channel, if you find value in this, I'd very much appreciate it. It's very helpful as far as search engine stuff is concerned. If you would like the video, and just as important, if you make some comments, if you like the video, tell me what you like about it. If you don't like it, tell me what you'd like to see. If you have questions, let me know. I'm happy to answer your questions. I do this report every week. It is an addendum to the weekly report that all of you, or most of you, should have received that accompanies this. If you did not receive that weekly report and you've stumbled across this from some sort of YouTube algorithm, then if you'd like to receive a written report that I do every week, it's free. Just email me to tom@alexandertrading.com. I'll put you on the list, and I'll immediately send you this weekend's report, and you will automatically get reports down the road. Okay, so let's talk about where we are. I'm going to start with a little bit bigger picture. I'll head over to the screens here. Now, the view you see here, these are charts of the 4 primary U.S. trading indices. These are the weekly charts. And I only have upside levels highlighted. I will get to the downside level in a more granular view. But, I spent a lot of time going over this and thinking about what these charts say. And one thing I want you to notice is the relative strength of the Dow versus the other indices. And if all of the indices, the Dow, the SPX, the NDX, and the RUT, were to close, make a weekly close above the levels you see highlighted here, it's a signal the bear market is over, and we're trading to new all-time highs in one or more of the indices before there's anything substantial to the downside. Now, that's not a prediction that's going to happen. I'm a price-based trader. And everything that I'm a price-based trader through the lens. There are a lot of people that are, price-based trading is the popular thing to be now, but through the lens of auction market principles, which is a different animal. So and I said this last week, it's fine to have an opinion, it's fine to have a narrative, but if you are a trader, if you have an opinion or you have a narrative, it doesn't do you any good unless you know what invalidates it. Now, again, right now, I would favor the downside in this market. I would favor the NDX and the Russell trade at a minimum, trading to new lows before there's any substantial rally. But looking at this objectively, if all 4 of these indices over the next month or so were to trade and close on a weekly basis above the levels highlighted on my screen, it's a signal the bear market is over and we're going to trade to new all-time highs. And that's not a prediction, it's just an observation. That's not really tradable information either. It's more gross analysis. It's more top-down analysis. Now, let's get a little more granular here, and let's go to the daily charts. Now, the daily charts are quite interesting from a number of perspectives. Number one perspective is that they are in balance areas. Balance areas from an auction market perspective, auction market / market profile perspective. That's one of the basic 2 fundamental market conditions in an auction market. You have a trend and you have balance. Markets spend most of their time in balance. That's just because of trade facilitation. It's because of how auction markets are designed to work. That means you have an efficient market. You have a market that is facilitating trade. Trending markets are unbalanced. They are not facilitating trade. They are directional markets. Okay, so we are in markets that are coiled up in all of the indices to varying degrees, and I have highlighted the important upside and downside levels. Now, it's a little bit layered in both the SPX and the NDX. I have not broken down the Dow or the Russell beyond this upper extreme and lower extreme you see highlighted. Now, let's take the SPX. So we're in a balance area. And the next thing that's going to happen, you're going to get a sharp break. You're going to get a sharp break and some sort of multi-day move out of these balance areas. Now, you can say this is the upper extreme, this 38.89, and the lower extreme, 37.64. But the reality is, we spent most of the time trading even in a tighter range than 38.58 and 37.80. So how do you trade this? Well, as a trader, I'm going into next week and I'm reading every single day very carefully. And as an intraday trader, I'm going to be very aware of what the short-term conviction is. In other words, the wide range bars. What is the direction of the wide range bars, both daily as well as intraday? If I'm trading on a 30-minute chart or a 5-minute chart or even a 1-minute chart, I don't want to be fading conviction. I don't want to be fading wide range bars. And my strategy and my tactics in all time frames is driven by market condition. So the market condition right now is conducive to these sharp moves. And that's true whether I'm trading a 1-minute chart or a weekly chart, frankly. Same concept applies. But now if we close above 38.58, it's a really good signal that we're going to go ripping higher to one degree or another. This is an elevator shaft above 38.89 that extends all the way up into 39.57, 39.97. Conversely, to the downside, there is decreasing quote unquote potential support below the low of 1222 until you get to new all-time lows. All right, let's look at the NDX. It's a very similar picture there, as you would imagine, because the SPX and the NDX, the ES and the NQ are extremely highly correlated. So here are the same equivalent levels in the NDX. A close above 11,015, it opens the door to at least 11,286. A close below 1077.60 opens the door to at least 10,671, and more likely to me, probably a test and lower lows down here. Now, it would be really, really interesting if in the first few days, 5 to 7 trading days of 2023, if the NDX trades to a new low for the bear market. At that point in time, what we will want to do is take a look at the other indices and see where they are, because it could set up a very bullish situation when you have one index making new all-time highs or new all-time lows. That is a recipe for a potential very important pivot turn. In this case, it would be a pivot turn back to the upside. We shall see. Don't want to get too far ahead of ourselves, and that's something certainly we'll be covering in next weekend's report. I'll be covering it every day for members. Now here's the Dow. And the Dow is just holding up extraordinarily well, but you can see it's in a very two-sided trade. It's in a balance area. A close above the upper extreme has to be respected. A close below the downside almost certainly means that everything else is heading lower and the Dow is heading lower to one degree or another. The fascinating thing about the Dow is this was an extraordinary move with very shallow and short-lived retracements off the 1013 low. Just extraordinary. And then finally, the Russell. Russell, of course, is the broadest spaced index, so it's the hardest to, quote unquote, manipulate. And we want to all be paying attention and honor a close above 1784 or close below 1722. In the meantime, we're coiled up in a very tight area between those two levels. Okay, so what does the technical picture look like that we typically cover? And let's take a look over there. Let's go over there. Okay, breadth. Breadth is neutral. Breadth reflects the internals. And when I say breadth, I'm talking about NYSE advancing and declining issues. I don't use unchanged issues. And I realize the limitations of using NYSE breadth to analyze 4 different indices, but over my 38-year career, I've used this. It's a wonderful analytical tool. It's somewhat of a blunt instrument. It cannot be rote traded. It is contextual. And right now, the red line on the bottom is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of advancing issues. And then you see breadth below. I'm going to show a shorter term picture of breadth in a minute that I think reflects the balance area trade that we've been in for the past really 2+ trading weeks, 2+, 10+11 days or so. But you can see we're coiled up in here, and then the internals are going to break one way or the other with price. There's no big divergent tail. There's nothing extreme in this breadth work itself. So this is reflective of where we are from a price perspective. It's neutral. It can break either way, and there's plenty of room for it to run to the upside to get to an upper extreme, or to the downside to get to a lower extreme. Now I want to show, while I'm here, let me find this. Let's see here, bear with me, here we go. Okay, this is a 30-minute view. Now this is basically the cash session of the ES, of the futures market. But you can see we've had these extremes reached in breadth that typically portend continued movement in that direction. But we haven't had that. What we've had is just a complete chop fest in breadth that reflects the chop fest that we've seen in price. Now we're coming out of the end of the year and all the end of the year machinations. Next week, we're coming into a new year. We'll have new year machinations, but the new year machinations are probably going to be more positioning for the future as opposed to squaring off the books type of thing that you typically see year end by the institutions. So directional bets will begin to be made by the institutions next week, which could be the catalyst for the next sharp move, whether it's up or whether it's down. But breadth, as you see here, reflects the chop fest that we've been in for the past 10 or 11 trading days. Okay, let's go back to this chart. And I want to show VIX. And here's the S&P, and here's the volatility index under it. Now, we had this nice, neat pattern that went, and that was true since the beginning of last year now, 1 year ago. When VIX dropped below 20, we were near highs, and then we really didn't see pivot lows until VIX hit around 30. Well, we've gone the longest time with VIX not making some sort of extreme. So every single thing, everything we watch, from price structure, the internals is using breadth, and then VIX. This is a long time in a narrow range for VIX. If this thing breaks to the downside, VIX is likely to increase. If it breaks to the upside, VIX is likely to decrease, and then we see, we'll see VIX below 20 for some point in time until the market turns around. At that point in time, we'll really be watching these upper levels that I have highlighted on the other charts very carefully. So, guys, let's get ready for what could be a really interesting beginning to 2023. I will keep you updated. Happy New Year. I'll speak with you again very soon.